Welcome to Simple Mind Space, your go-to podcast for all things related to personal growth, mindfulness, and self-discovery. In today's episode, we're diving deep into a fascinating and frankly, rather unsettling aspect of our global system, the world of money, and more specifically, who really controls it. You might be thinking, isn't this a little heavy for a mindfulness podcast? And you wouldn't be entirely wrong. But trust me, understanding the intricate workings of something as fundamental as money can be incredibly empowering and, dare I say, even liberating. It allows you to see the world with a clearer lens, making more conscious decisions about your own financial well-being and contributing to a more informed and engaged society. Now, before we get into the nitty-gritty, let me preface this by saying that this topic might challenge some preconceived notions about how our financial world operates. It's not about pointing fingers or creating fear. It's about fostering understanding and encouraging critical thinking. The question we're exploring today is deceptively simple. Who controls all of our money? It's a question that seems obvious yet rarely gets asked or addressed, particularly in traditional educational settings. We all know that you and I, the everyday citizens, don't have direct control over the money supply. Our employers, our bosses, the CEOs, the politicians, none of them truly hold the reins of this intricate system. So who does? Where does money even come from in the first place? Let's rewind the clock back to 1694, a pivotal year in financial history. England had just emerged from a grueling 50-year period of war, leaving the government in dire need of funds. Their solution? A revolutionary concept, at least for the time: a privately owned bank with the power to issue money to the government. This was the birth of the Bank of England and the world's very first modern central banking system. This model, where a private institution essentially creates money out of thin air and lends it to the government, might seem a bit mind-boggling, even today. However, it's a model that has profoundly shaped the financial landscape of the world. Fast forward to the early 20th century, and across the pond, a similar story was unfolding in the United States. After two failed attempts to establish a central bank, a clandestine meeting of 7 prominent bankers took place on Jekyll Island, off the coast of Georgia. This secretive gathering, shrouded in an almost cloak-and-dagger atmosphere, lasted for 9 days. The result? The birth of the Federal Reserve System. It's worth noting that this meeting was shrouded in secrecy, with attendees taking pains to avoid any media attention. Why all the secrecy, you might ask? Well, it turns out that the American public had a deep mistrust of central banks at the time. Their concerns stemmed from a historical awareness of the potential for wealth inequality, economic instability, and the undue concentration of power in the hands of a select few. However, this group of bankers, representing a quarter of the world's wealth at the time, was determined to establish a central bank in the U.S. They publicly presented the Federal Reserve as a stabilizing force, a means to curb the power of Wall Street banks, and ensure a more stable economy. But here's where things get a little tricky. The very same individuals who crafted the Federal Reserve Act were the ones they claimed it would hold in check. Essentially, they were creating a system that gave them, a select group of private individuals, the power to create money from nothing and lend it to the government, with interest, of course. This system, as well-intentioned as it might have been in theory, set the stage for the rise of a debt-based monetary system. A system where the creation of money is intrinsically linked to debt. Every time a loan is issued, new money is created, leading to an ever-increasing pool of debt. Now, you might be asking yourself, how does this relate to me? I don't even live in the US. This is a global system, my friend. The US dollar has served as the world's reserve currency since the end of World War II. This means that central banks worldwide hold US dollars in their reserves, making their own currencies dependent on the actions of the Federal Reserve. This interconnectedness means that when the Federal Reserve creates more US dollars, it inherently devalues not just the dollar itself, but all other currencies tied to it. It's a ripple effect that can impact economies worldwide. So, what are the implications of this debt-based system? Well, one of the most significant consequences is inflation. When more money is created, the value of each unit of currency decreases, leading to a rise in prices. This can erode the purchasing power of your hard-earned money, making it harder to afford everyday necessities. In essence, inflation can be viewed as a hidden tax, a consequence of the system that everyone pays for. It's a system where debt has become the backbone of our economy. As former Fed Governor Mariner Eccles stated, if there were no debts in our money system, there wouldn't be any money. Think about that for a moment. Our entire financial system is predicated on the existence of debt. This system also empowers central banks to manipulate economies by controlling the money supply and interest rates. By lowering interest rates, they can encourage borrowing, stimulating the economy, and creating a temporary sense of prosperity. However, this can also lead to dangerous bubbles, like the housing bubble that burst in 2008. As former Governor of the Bank of Canada, Graham Towers, aptly stated, each and every time a bank makes a loan, new credit is created, new deposits, brand new money. This system, while seemingly complex, boils down to a simple principle: debt equals money. And as long as this system remains in place, there will be a constant need for more debt to fuel the economy, often leading to unintended consequences like inflation and financial crises. Now, this is not to say that central banks are inherently evil or that all debt is bad, but it's crucial to understand how this system works, its potential pitfalls, and the power it grants to a select few institutions. So, what can we learn from all of this? Firstly, understanding the debt-based monetary system can help us make more informed financial decisions. We can become more conscious consumers, prioritize saving and investing wisely, and seek alternative financial models that are not solely reliant on debt creation. Secondly, it's crucial to foster greater transparency and accountability in our financial institutions. The creation of money, a process with such far-reaching implications, should not be shrouded in secrecy. And finally, this knowledge should empower us to engage in constructive dialogue about alternative financial models that could potentially address the inherent flaws of the current system. It's a topic that deserves our attention and critical analysis, as it profoundly impacts not only our personal financial well-being, but the future of our global economy. Thank you for joining me on this deep dive into the world of money and central banking. If you found this episode insightful, please consider sharing it with your friends and family. It's time to shed light on this often overlooked aspect of our world and encourage greater financial literacy for all. If you enjoyed this episode, be sure to like, share, and subscribe to Simple Mind Space for more thought-provoking content. Until next time, stay curious, stay mindful, and keep exploring the vastness of the Simple Mind Space.